the worst possible thing that can happen is when you underestimate your adversary. These have been, of course, some of the biggest blunders in history. And you're seeing it right now in the trade war. This belief that China's about to collapse. We're going to push them a little bit. We're going to put in some tariffs and the economy is going to implode. It's brought us to the situation we're in, where now all of a sudden the White House has to backtrack very, very quickly and look quite foolish in doing so. Now, all of a sudden, China is basically self-sufficient in every industry. It's actually leapfrogged the Western world in every industry. Again, you see it in the cars, you see it in the telecom switches, you see it in the batteries and the solar panels, you name it. China is much more able to withstand the shock from a possible trade war. You underestimate your opponent, to be honest, at your own detriment.
This is Louis-Vincent Gave. He's the CEO of Gavekal Research and one of the sharpest insiders when it comes to understanding China's economy and global markets. In this interview, Louis breaks down what most people in the West are getting completely wrong about the U.S. China trade war. We talk about how the Trump tariffs, which were supposed to hurt China, have already started to be reversed, and why China is actually better positioned today to weather this economic storm. You'll hear why the trade war really started in 2018, how China's growing trade surplus and the evolving role of the RMB are creating new challenges, and what that means for the global economy, from supply chains to stock markets to international investing. We also dive into the future of Hong Kong, how to invest in China today, and why domestic innovation, not exports, is now driving China's rise. This is a wide-ranging and brutally honest conversation, one that challenges mainstream narratives and reveals how the world is really shifting beneath the surface. Let's dive in. Well, everyone, I'm very honored to welcome into the studio today Louis-Vincent Gave. He's one of the most respected macro strategists in global finance. He's the co-founder of Gavekal Research, a top-tier investment firm based in Hong Kong and a leading voice on China's economy, emerging markets, and the global monetary policy. Louis, how are you today?
That's a very flattering description. Thanks a lot, Cyrus. I really appreciate it. I don't know if it's true, but I'll take it. But thanks for the kind words. Thanks for having me on.
Well, Louis, I don't think that the timing could be better, because this is just we have so much to discuss today. Obviously, the tariff war between the United States and China today, and actually, I'm going to start with your pinned tweet. I think this is a really interesting thing to start off our conversations. When you say, one of my go-to themes in recent quarters has been how the negative bias in Western media against China is doing readers a massive disservice. And I have argued incessantly that instead of preparing for a world in which China emulates, policymakers and business leaders need to prepare for a world in which China catches up and sometimes leapfrogs the West in industry after industry. Give us a little bit of insights into why this is your pinned tweet and what people are really missing.
In a world in which, if you just open your eyes, you see that Chinese cars are now much better than Western cars and cheaper. And you see the high-speed trains in China, and you see the fintech, and you see all the development that there is. The extent to which the narrative in China has remained around China has been stuck for about 10 years on the place is about to implode. Now, it's not that everything is rosy in China. China is a massive country, of course, 1.2, 1.3 billion people. It's the world's second largest economy. You can always find examples for whatever you want. Like I can give you great examples of progress, and you can give me great example of things moving backwards and things imploding. Just like you could in the United States, right? You could find you can go visit the Silicon Valley and decide, wow, the future is being built here. Just as you can go into the Appalachians and feel, oh my God, I've fallen into a pit of despondency. And China is a massive economy, so you could point to either way. What's been fascinating to me is the extent to which the negativity surrounding China and the media is all encompassing. And I know you've followed China as well for a long time, and it feels that you just move from one extreme to the next. It's either you go through 10 years, oh my God, China's going to conquer the world, and it's going to take over everything, to suddenly you switch to, oh my God, China is imploding, and it's going to war, or it's going to be all these devastating things. And there's no doubt that in the past 10 years, we've been in this cycle of China's imploding, et cetera, mostly because, what had been the driver of growth, namely real estate, hit the skids. And I think because we went through in the Western world some pretty bad real estate bust, of course, US in 2008, Europe in 2012, 2013, there was a perception of, oh, China's going through a real estate correction. I've seen this movie before. Now the banks are going to go bust, and the shadow banking system is going to go bust. And I know exactly what to do because I've seen this before. So there was a lot of projection of our own experiences onto a Chinese system that frankly functions completely differently. The financial architecture of China is completely different from that of the West. The banks fund themselves from retail savings. They don't fund themselves through money markets. They're actually much more conservatively ran actually than Western banks. So the bottom line, you've ended up with a very, very different outcome. But once people decide, oh, I've seen this movie, I know where it's going, they just get stuck on. And I think it's been a particular disservice, and we're seeing that right now. You're seeing it in the trade war, where I think the worst possible thing that can happen is when you underestimate your adversary. When you think, if I'm going to walk in here and these guys are going to fold in a New York second. These have been, of course, some of the biggest blunders in history, and you're seeing it right now in the trade war. This belief that China's about to collapse. We're going to push them a little bit. We're going to put in some tariffs and the economy is going to implode. And it's brought us to the situation we're in, where now all of a sudden the White House has to backtrack very, very quickly and look quite foolish in doing so. And that's where we are. You underestimate your opponent to be honest, at your own detriment.
No, I think that's a very good analysis right there, Louis. And I think what's interesting is, I've heard this quote before was, there's two types of foreigners, ones that hate China and ones that have been to China. And
Yes.
I think it's such an interesting, phenomena for me, especially here, being based in the United States and people's perception of China. I'm just amazed. It's still stuck 50 years ago. It's still this poor country. It's still, you can show them all the pictures, all the videos they want, but they just can't seem to process that. And I think obviously if you only rely on Western media, I mean, every day the sky's falling in China, right? It's going to collapse any second. You've got guys like Gordon Chang who've been basically chanting this for decades, that China's going to collapse any second. But, you really need to go on the ground and see that. And like you said, the proof's in the pudding here with this trade war. Let's talk a little bit more in specifically about this trade war, because, there was a recent Financial Times article that said, that China is actually prepared to weather the storm and really battle, the United States and Donald Trump with this. Can you kind of break that down a little bit further? What is the strategic advantages that China has in this trade war against the U.S.?
Yeah, so actually, funnily enough, that FT article was written by my business partner. It was written by my business partner, Arthur Kroger. And Gideon Rackman also wrote one just shortly after. But you're right. I just want to pick up on a couple of things before I answer that, a couple of things you say, because I think it's absolutely right. The first is, very often the picture that Americans have of China is it's like North Korea.
Yes.
It's like one party states where the government controls absolutely everything, and people have no choice but it's essentially to be indentured labor, and which was the case 50 years ago, no doubt about it. That was
Correct.
what China was. And when you say, no, look, this isn't what's happening, when people say, oh, well, does that mean you believe in central planning? And I always say, no. The reality of China is that China's gotten better and better by gradually liberalizing labor first in the 1970s, liberalizing land in the late 90s and 2000, liberalizing slowly the world of capital allocation. And so it's a constant evolution from a place that indeed was like North Korea and is getting better, all the time. And again, you can pinpoint to anything. It's not going all smoothly in one direction. It's always sort of 3 steps forward, 2 steps back. But by and large, when you look at the progress over time, you are making steps forward. And yes, to your point on the two kinds of foreigners, I've sort of adapted that saying by saying there's really two kinds of foreigners. There's two kinds of foreigners. There's the ones who go to China and come back and say the future is being built over there. I saw flying cars. I saw 450 kilometers railroads. I saw 6G telecoms. All these things that China is unfolding. Foreigners come back and talk about them, and then the foreigners that don't go look at the first kind of foreigner and say, "You must be a CCP shill. You must be getting paid by the party." And you're like,
Right.
"Oh." Anyways, leaving that aside, coming back to your question of the trade war, the reality is the trade war didn't start in 24, not for China. For China, the trade war started in 2018. The single, most important event for China of the past decade or so was the U.S. blocking semiconductor sales to China in 2018. When that happened, the Chinese leadership thought, okay, the U.S. is declaring economic war on us. The U.S. is now trying to prevent us from growing. Today it's semiconductors. Tomorrow it could be auto parts. It could be chemical products. It could be any number of things. We have no choice but to build self-sufficiency and resiliency in every single industrial vertical. And incidentally, that's when the real estate bust started. Because in 2018, the Chinese government told the banks, guys, no more loans to real estate. From now on, all the loans go to industry. And so you saw loans to real estate absolutely collapse. You saw loans to industry go through the roof. And so, yeah, fast forward 6, 7 years to today. Now, all of a sudden, China is basically self-sufficient in every industry. It's actually leapfrogged the Western world in every industry. Again, you see it in the cars, you see it in the telecom switches, you see it in the batteries and the solar panels, you name it. And China is now independent. So yeah, I think that China is much more able to withstand the shock from a possible trade war. What are the means of pressure that the U.S. has? The semiconductor card has essentially been played, and China has now spent 6, 7 years spending a lot of money to move up the value chain on semiconductors. It's not yet at the very peak, but it's getting close enough. So that card has been played. You have the energy card. That's why China spent so much on solar. That's why China spent so much on wind, so much on nuclear. But now China has built pipelines into Kazakhstan. It's built pipelines into Russia. And to be honest, to play the energy card, the U.S. would have to go to places like Qatar and like Saudi Arabia and tell them you're not allowed to sell to China anymore. And it's not obvious that these guys would go along with the U.S. this time around. It's not obvious that these guys would go along with the U.S. because China is now their biggest customer, right. and the U.S. is no longer a customer. The U.S. is now independent self-energy. So the U.S. goes to Saudi Arabia and say, hey, you can't sell to your biggest customer anymore. Saudi Arabia is going to say, so who am I supposed to sell to? So the methods of pressure, I think, on China for the trade war are actually decently limited. The one method of pressure the U.S. could conceptually have had was to go around to ASEAN, to go around to Europe, to go around to Latin America and say, hey, I know that China's your biggest trade partner, but come on, like these guys have an undervalued currency. They're running a 1.1 trillion trade surplus. This just can't last. So let's all get together and force China to revalue and force China to stop running $1.1 trillion trade surplus. That conceptually could have worked because, a lot of these export markets are now more important to China than the U.S. China now exports roughly 20% more to ASEAN, the Association of Southeast Asian Countries. It now sells 20% more to Southeast Asian countries like Indonesia, Malaysia, Thailand, than it does to the United States. So if the U.S. had been able to build an anti-China coalition, that could have been powerful. But I think that chance was gone as soon as Trump decided, I'm declaring a trade war on everybody all at once, all together. When it did this, essentially, it opened up the avenue for China to say, look, the U.S. is not a reliable partner. They change their mind every 24 hours. We're here. We're steady. We'll continue to invest in your country. So I think that ship has now sailed.
Yeah.
And so the U.S. is today in a position in its trade war, which, it started 3 weeks ago, 4 weeks ago, with a trade war on everybody. Then it started to try to morph it to just a trade war against China. And now it's already trying to walk back its trade war against China. It's actually almost comical where Trump yesterday comes out and says, oh, we had a great meeting with the Chinese, things are moving forward. And Xi Jinping comes out and says, we didn't meet. What is he talking about? And you're now left in this, I can't help but think of, T. Boone Pickens' old quote that when you want to deal real bad, you get a real bad deal. And this is the situation that the U.S. has left itself in. Because, in a few weeks, the shelves will be going empty at Walmart. They'll be going empty at Target. You'll have a 4th of July with no fireworks. You'll have a back-to-school shopping that will cost twice what it was costing. This is essentially what the CEO of Target, the CEO of Walmart that met recently with Trump just highlighted. They literally sat down with him and said, look, the back-to-school shopping a year ago, the back-to-school shopping this year is going to be plus 75%. And that we're just sharing with you that information. So yeah, you want to deal real bad, you're going to get a real bad deal. I think that's the position the U.S. has left itself in. Meanwhile, China is sitting back doing nothing and letting Trump negotiate against himself. Like every day, he's like changing the tariffs. Every day, he's lowering things. Like, I'm excluding this. I'm doing this. I'm doing that. He's just negotiating against himself. If you're China, why would you stop? You may know Napoleon's old saying that if your enemy is making a mistake, you don't interrupt him. Right now, Trump, again, is negotiating against himself. China's staying quiet. I think it's the best thing they can do.
Yeah, no, that's a fantastic analysis. And, there's another quote that is very funny here. Louis, is from Trump's book, The Art of the Deal. It says the worst thing you could possibly do in a deal is seem desperate to make it. And I find it just baffling how Donald Trump has gone down this path. And I guess he's really painted himself into a corner. I mean, he doesn't really have any other option. And I mean, this was just very, very unsustainable from the beginning. But I really like your point is that, there was an opportunity to potentially leverage against China, but that was certainly getting the rest of the world, to align with the U.S. and maybe isolate China. But that ship sailed because Trump really tariffed everybody. I mean, you had countries like Cambodia and Vietnam who were just, quietly doing their thing, and then all of a sudden hammered with a, extravagant tariff. And even the way that Donald Trump calculated the tariff was completely inaccurate. And once that formula was spread online and people realized that his advisors, they can't even make a correct mathematical calculation, they have no idea what they're talking about. I think this really started to sow a lot of seeds of distrust for the US on the world stage. And I know that you spend some time in Canada. My wife is Canadian, we spend time there as well, and I kind of look at our closest ally, Canada, how the United States has treated Canada. So it's an interesting one because we have Trump saying, I want to use this tariff war to force countries to choose between the U.S. and China. And I don't think he's going to like the answer that he's going to receive, because if Canada is any precedent into how you're going to be treated, our closest and most loyal ally, I don't think countries are going to sign up for that. Why would you be wanting to sign up and align with the U.S. if that's how you are going to be treated? I mean, we look at Denmark, obviously a close ally. Trump has threatened their sovereignty by, we're going to take it. We're going to take Greenland. It's a NATO member. It's a sovereign piece of territory, but yet we're going to take it. Canada's the 51st state. I just think this rhetoric is so dangerous and so unpresidential from President Trump.
Well, it's more importantly, it's unproductive, right? To your point, it goes against the goals that you want to achieve. So yeah, I think that part is disappointing. And look, the challenge today, if you're a foreigner and you look at the Trump administration, is it feels like it just keeps picking new fights all the time, right? It's like we start off, we're going to fight the deep state, we're going to fight the CIA, the FBI, etc. And a lot of people voted for that, and
Right.
people get excited about that. And we're going to fight big pharma, and we bring Bobby Kennedy on board, and we're going to fight the FDA and the regulatory capture and all the poison that goes into the food in the U.S., et cetera. And a lot of people were on board with that. And so there's a fight there, and I think a fight very worthy and worth fighting for. And then we're going to fight, the global unfair trade practices, and there's a lot of them. But here, it's like, how many fights can you fight at once?
Right.
And the thing you want to do usually is you start a fight, you finish it, you win that fight, and then you move to the next fight. You don't have like 20 fights all at once, because yes, it scares the hell out of people, out of your partners, out of your allies who no longer feel that you're a trustworthy counterpart.
Right.
And on this, I was talking about this with a friend of mine who runs a successful private equity firm, and he was telling me that in all his years in private equity, he's done a lot of deals. And he's dealt with, different types of deal makers, but invariably, when you deal with somebody very tough, sometimes you have a tough negotiation and you walk away from the negotiation thinking, wow, that guy's really good. He's tough, but he's hard. And next time around, I need to be on the same side of the table as he is. I don't want to be across from the table. I want to be on the same side. And then you get every now and then you get a deal and you get someone across the table who's just a jerk, and you think, I never want to do a deal with that guy again. It's not that I want to be on the same side. I just don't want to be anywhere near him. And I think, for a lot of Western countries, there was always a feeling that the United States was the first kind. It was a tough negotiator. The U.S. would, do what was good for the U.S., but invariably you wanted to be on the same side of the table as the U.S. Like whatever happened, you wanted to be on the same side. Yes, the U.S. was tough, but it was better to be on their side than in another side. And today, I'm not sure that's still the case. Meanwhile, the U.S. going around saying, look, we're going to tell everybody it's us or it's China, while at the same time, it is backtracking furiously on its own sanctions against China. It's not very credible. And it's all the less credible that, if you look at, whatever it is, 170 countries in the world, 110 countries, China's already their biggest trade partner. And so, you're left with this quandary of, I'm not sure it works. And now for some of these countries, it's actually great news. It's great news because if the status quo stays, like for a Vietnam or an Indonesia, they're back down to 10%. You know that all the Chinese exports are going to get rerouted through Vietnam.
Right.
Yeah, they'll move to Vietnam. They'll stick a made in Vietnam and then they'll ship it to the US. But the Vietnamese ports can only handle so much. So, Vietnam will make lots of money. It'll be great for Vietnam. They'll catch a little, they'll get a haircut as an intermediary. It's very bullish Vietnam. It's very bullish for Indonesia. But, it's like, you're not going to be able to ship as much. The reality is Vietnamese ports are supply constraints. Indonesian ports are supply constraints. Seven of the top 10 ports in the world are now in China. So you can't, there's only so much you can reroute through other countries. So there will be supply chain dislocations for the US for sure.
Let's talk a little bit about that, in context to this trade surplus, because you have mentioned that China does have this very large trade surplus. And how do you interpret that for the future? Is this something that is sustainable for China? Is this a risk to them and their economy? How do you see the continuation of that in the future in regards to this trade war?
Well, so it's sustainable for China, but I don't know if it's sustainable for the world. China's trade surplus, if you think of it, global trade is roughly 25 trillion a year. China's trade surplus is over 1 trillion now. So just the trade surplus, not the trade surplus is 4% of global trade. This is simply unprecedented. Like we've never seen anything like this in the world. And it speaks to the level of undervaluation of the renminbi. I know you spend time in China. When you're there, it's dumbfounding how little things cost.
Right.
You can stay in great hotels. You stay at the Four Seasons in Beijing or the Four Seasons in Shanghai for $200 a night. Good luck getting a crummy hotel room in any New York, Washington, D.C., Boston, any major U.S. city for less than 500. So, China is today, and you go to restaurants, it costs nothing. You can buy cars for less than 10,000 US, like great cars. The currency is just too cheap. Deep down, I think having a Chinese trade surplus that's 4% of global trade creates too much of an imbalance. I think we're going to end up either with, where Trump should have been able to build like an anti-China, proper coalition of saying, guys, either you revalue or we're all going to tariff you together. There was that window of opportunity. Now it's closed. Either you end up there, or I think China's going to have to start revaluing because it's creating too much of an imbalance.
Right. I definitely agree with that. And I want to let's kind of shift a little bit more to this the stock market right now in the United States, because I'd like to get your insights. Obviously this is your area of expertise. We've seen a tremendous amount of loss under Donald Trump. I think I saw a graph of confidence in the economy. This is amongst polls from the American citizens. Confidence in Donald Trump leading the future of the economy. Confidence in the American economy. Obviously we've seen that absolutely hammered, multiple days where the Dow is down by thousands of points. And, obviously the market right now is really following the tariff news, right? As soon as Trump announces a 90-day pause on tariffs, boom, massive gain. Of course, Trump takes full credit for that, but it's almost like he's the arsonist and the firefighter at the same time. He sets the market on fire, but guess what? I've got the cure. Let me just put the 90-day pause, and we're going to get that going up. But I think, unfortunately for the U.S. right now, is there's so much uncertainty. I've talked to a lot of people in many different industries. Almost no companies giving guidance. No one really knows, what's going to happen. Because like you said, it could change every 24 hours. It seems to be something new from the White House. How are you looking as far as like U.S. equities are concerned right now and the future of the U.S. stock market? How are you looking at that from your investment angle?
Look, my starting point is that, obviously it's a super important question, but my starting point is that from 22 to 25 or late 24, the U.S. stock market added 20 trillion in market cap. You went from a $40 trillion total market cap to 60. And it wasn't because there were a bunch of IPOs and new companies listing and all these things. It was literally every marginal dollar in the world went into a handful of stocks. And it was a handful of stocks. Because you look at the Russell 2000, it went nowhere. You look at the small cap, the mid caps, that went nowhere. It was literally, sort of 15 US stocks. We called, I know people talk about the Max 7, but it wasn't just the Max 7. It was really the Nifty 15. Now, to put things in context, the total market cap of Europe is about 7 trillion. The total market cap of Japan is about 6 trillion. So in the past 2 years or 2.5 years, the US added more than Japan and Europe put together in terms of market cap. And a lot of that excitement was, it corresponded to a few things. Part of it was the US, unlike the rest of the world, was going through massive fiscal stimulus, and I would say pro-cyclical fiscal stimulus. You had essentially in 2022, you had a situation where the US was running, nominal GDP growth of 5-6%, unemployment was 4%. And Biden came out and said, we're going to do another $1.5 trillion of stimulus. So you had extra fiscal stimulus, number one. And number two, you had all the excitement around AI. Right? There was all of a sudden this belief that AI was a golden goose. It was going to generate excess cash flows, and that only a handful of U.S. companies were really involved in that space. Because to be involved in that space, you needed to be able to spend $100 billion a quarter in capex, and there were only so many people who could do that. And this is what, of course, these two things have now disappeared.
Right.
The fiscal stimulus under Trump is gone. We've moved from fiscal stimulus to Doge and trying to control the excess government spending, number one. And number two, the idea that AI was going to be this golden goose has been shot in the head. That idea, as when DeepSeek came out and said, you know what, we built this with a piece of strings and a piece of bubble gum, and it's as good as anybody else. And it essentially highlighted that the hundreds of billions of dollars that have been spent in AI capex were a write-off. And so I think that was an important shift for the markets. More importantly, in terms of AI, it signaled we're now in a world in which China is also an AI player. Now, one of the things I've learned out of my 30 years in Asia is that when China enters a room, profits walk out. It's like the last thing you want to do in life is compete with the Chinese. Like if you find yourself competing with the Chinese, your career has taken a really wrong turn. And you need to reevaluate. And that's essentially where U.S. tech is today. And so we now have this paradigm shift where the two things that push the market from 40 trillion to 60 trillion are now gone. And instead, where you're seeing the fiscal stimulus is no longer in the US, it's now in Europe and it's China. And so the marginal dollar is no longer going to go to the US, it's going to go to Europe, it's going to go to China. And I think that's already happening. So unless you get a new super exciting thing in the US, like something that promises to build more capital spending, something that promises to build more productivity, something like the shale revolution and from 2005 to 2012, or something like the launch of the smartphone, which created a whole new ecosystem and get everybody fired up. Unless you get something like this, it's like, okay, the age of US exceptionalism just died with DeepSeek. DeepSeek essentially put a stake through the heart. So you went from 40 to 60 on the belief that the US could do things that nobody else could, and now you're going to have to walk it back. And by the way, if you go back to 2000, I think it's 2014, so 10 years ago, the market cap of the US was 20 trillion. So you've gone from 20 to 40 to 60, and over this decade, have you had massive productivity gains in the US? You had huge productivity gains in energy, and the smartphone ecosystem was very exciting. These were the two pillars on which this boom was built. Where do you go from here? You need a new exciting things. If you don't have that, then for the marginal dollar to keep flowing in the US, you either need China to implode or you need Europe to implode. Unfortunately, I think right now both places are going in the other way. Europe is, doing fiscal stimulus. Bank loans are accelerating. They're humming along on the back of cheaper energy costs. China is also doing okay on the back of cheaper energy costs. The government is doing more fiscal stimulus. While there were fears that the trade war would mean an implosion in the Chinese economy, I think we're quickly realizing that actually the weaker link on the trade war may well be the U.S., as you and I discussed earlier.
Oh, that's a phenomenal insight, Louis, and that's why I'm so happy to have you on the show today. So we can understand that. I mean, I think we're looking at now. There's going to be a lot of stimulus moving forward in China, and I think that could potentially create some really unique investment opportunities. And this is really your area of expertise, and this is a question that I get multiple emails every single day. People are always interested in, how do we capture this, this future momentum for China? It really does seem that they are inventing the future. Like you said, if you're a foreigner that goes to China and you have an open mind, the logical conclusion is like, wow, this country literally is inventing the future. The future is in China. It's being built. You can go to Shenzhen, the Silicon Valley of China, and you can see these companies, the innovation, I mean, it's just totally different. And so I kind of want to shift now to that. How are, for example, if people are interested in investing in Asia or specifically China, what is the best way, the best vehicle for them to get involved, and what does that look like?
First, look, there's of course ETFs. If you're a retail investor, there's ETFs out there, whether FXI, which is the broader market. There's KWEB, which is one focused on tech, and that's the easy way. And I would say the beauty of these is they're liquid. They're easy to come in and out. That's the path of least resistance. And if tomorrow you change your mind or things somehow get worse in China, you can always change your mind, and that's it's easy. So that's one path. I think if you're a more committed investor, there's a lot of great managers out there. Well, there's fewer than there used to be, but because it's been a rough ride. But then you look indeed as to where the opportunity set is today. And I think when I look at the Chinese landscape, for me, there's different opportunity sets. One opportunity set in which we're involved as a firm is the deeply distressed debt. You have a lot of debt today in China trading at below 10 cents the dollar, because essentially you've had 7 or 8 years where a big part of the Chinese economy, i.e. the whole real estate, property, construction ecosystem, was deprived of capital. The banks just wouldn't lend to them, and tons of bankruptcies. More than 70 property developers went bust, and so a lot of that debt now trades for cents on the dollar. Meanwhile, you're now seeing the policy shift where the government tells them, okay, you can lend to these guys again, right. And so there's suddenly an incentive for a lot of these companies to work through their excess debt and to strike deals with the banks and restructure the debt. If you're an institutional investor, I think that's a very attractive pool to play in, because again, you got debt trading at cents on the dollar. So the asymmetric risk return is really quite a compelling proposition. So you've got that pool. If you're into the pool of more growth stocks, like you said, there's a lot of exciting things going on. The challenge always of the growth stocks in China is that if you have a great idea, very often you can have competitors pretty quickly. Here, the best example, of course, is what you're seeing in EVs now. I tend to think that BYD is going to be the biggest car company in the world. It's a tremendous car company. My favorite stat is BYD today has 110,000 people working in their R&D department. To put in context, Tesla has 90,000 employees total. So there's more people working in BYD R&D than there are employees at Tesla. It's an amazing company. It comes out with amazing products, amazing cars, but it has 129 competitors. There's today 130 EV manufacturers in China. That's a tough landscape in which to generate outsized cash flows. So what you see in China, in the research, we call it the Hunger Games of capitalism, is when a new good idea comes out, you have tons and tons of capital that comes in because China's savings rate is very high because the banks have capital. And then you go through 10 years of consolidation. And at the end, you have 2, 3, 4 players, and then these guys make outsized returns. So this is exactly the cycle we saw in batteries 10 years ago. And now you're down to essentially 3 guys. So now you can buy CATL. Now, maybe you buy BYD because it's both cars and batteries, but and you could say the same thing for the tech platforms. Like Tencent is now, you and I could have unlimited funding. We wouldn't be able to replicate Tencent and replicate what they have today. It's always the challenge in China is essentially you don't want to be too early. You want to wait for the consolidation, a certain consolidation in the industries. Yeah, then you can invest. So when you look at where the what's the new thing? Where's the excitement going to be in the next 10 years? You say autonomous driving is going to be huge, and China's huge in autonomous driving.
Right.
I think it's ahead of any other country. But concretely, how do you play it when there's so many players? You could say autonomous robots is going to be the big thing.
I think these humanoid robots as well, right?
It's humanoid robots like the Unitrees that you see on YouTube, and but so Unitree is enlisted, and there's UBtree, Unitree. There's a bunch of companies, and there's a lot of companies being funded right now for this. So it's like, is this really a place you're going to make money? Probably, but again, you're going to have to pick a winner between 20 companies. It's going to be tough. Do you just wait for the leader to emerge? Sometimes in China, that makes more sense.
Yeah, that's a really good insight. I think, just for some more context for our viewers, I think that's what's so interesting about China is that when you look at these industries, example, EV, it is so ruthless and cutthroat domestically within China, right? I mean, it really is the cream rises to the crop, right? I mean, there's going to be, 100 EV companies that start. Not all of them are going to make it. But again, if you are like the BYD that does rise to the top, you have had to compete very, very hard against your domestic rivals. And now you're at a point where we do see BYD, expanding tremendously around the globe and really having that global footprint. And it's almost easier for them to expand global once they've been able to survive the domestic market in China, because I don't know if you're going to find a place in the world that's as cutthroat and hard to develop domestically.
This is so true. And this is, we were saying, how the misperceptions of foreigners relative to China is like most people look at it as if it's North Korea.
Right.
And where in North Korea, we have like one car maker and like one steel maker, et cetera, and all the state resources going to this. Meanwhile, in China, it is cutthroat capitalism. It's like at the industry level, it is the Hunger Games, which, for the end consumer, you end up with better cars and cheaper cars. But for the shareholders, it's a tough grind because, do you want to be involved in competing in the Hunger Games against another 129 automakers? It's a hard way to make a living.
Yeah. No, you're definitely right. Louis, I've got two more questions for you. I want to specifically ask you a little bit about Hong Kong. I know it's a city that you've lived in for over 30 years. My wife and I lived there as well for a number of time. Our daughter was actually born in Hong Kong. She's a Hong Kong national. But I'd like to get your insights into this specifically. Given we know like Hong Kong is branded as Asia's world city. I'd like to kind of get your insights into how the city is navigating this U.S. China trade war and what does it mean for its future as a global financial hub.
So look, Hong Kong's had a rough 7-8 years. We had the riots. I think we had a government that massively overreacted over COVID, kept the lockdowns on too long. And when your purpose in life is to be a bridge between the East and the West, you can't stay shut down for 3 years. So I think we're still rebuilding from that. But on the positive side, here's what I would say about Hong Kong is if you look at the global financial centers, Hong Kong today is by far the cheapest to live in. Like it's not even close. We're relative to London, Tokyo, New York, Singapore, Dubai. There is the sort of value angle that we have. Secondly, in terms of quality of life, I think it's actually the best out of any of these cities. You live there, you've got the beaches, you've got the hiking, you've got the lack of crime, you've got the ease of doing business, sort of light regulatory footprint and, low taxation. So there is all of that. Now, against that, what's one of the bigger challenges? The bigger challenge is perhaps from an unexpected source is, the Hong Kong government, I don't know if that was already open when you left, but they put in a new train that goes to Shenzhen. So you go from West Kowloon to downtown Shenzhen in 18 minutes.
That's right.
And so now, like the young guys in my office on a Friday night, a Saturday night, they all go to Shenzhen to go drinking at night. People go to Shenzhen to get their eyeglasses done, to go to the dentist, why? Because it's less than half the cost. So I think that, one of the challenges for Hong Kong is China is just so cheap on everything. And coming in and out of Hong Kong is now so easy. You mentioned your daughter's, she probably has the Hong Kong ID with the stars on it.
Correct.
You don't even talk to a border agent. You just put your card in, just like it was a subway style, and you just walk in and out. The bottom line is there's too much of a price differential between Hong Kong and its neighbors. Imagine if you were living in Manhattan and you had a very nice, luxury, very comfortable train that took you in 18 minutes to a place that was just as hustling and bustling, just like lots of bars, lots of restaurants. Because Shenzhen is the Silicon Valley of China, it has been booming. And that was less than half the cost. How would you survive as a restaurateur or running a bar or running any kind of service industry in Hong Kong, in Manhattan under those circumstances? It'd be very tough. And so, that's the challenge. Now, Hong Kong has adjusted through deflation before. It did it 97 to 2003. Real estate prices went down 70%, wages went down by about a third, and people tightened their belt. And I think we're going through something not that dissimilar today.
Yeah, that's a good insight, though. I mean, that's definitely spoken like the expert that's been there for a long time, and I appreciate those insights, Louis. And as we kind of come to the conclusion today, and want to thank you for your amazing insights and your time. And looking forward now, what is really on your radar for the future of let's just say U.S. China relations, the future of the trade war? Kind of what is your, let's just say 6 months to 12-month forecast, and what's your, if you had a crystal ball, what are you kind of looking forward and forecasting for the next bit of the future?
All right, I'm not avoiding your question. I'm not.
Okay.
And I'll try to answer it. But I think actually, sometime when all the media and all the news, etc., bombards you with things, sometimes it pays to take a step back and say, okay, is this what's most important? And the reality, of course, everybody thinks, well, the U.S. and China are number one, number two economies in the world. Of course, that's most important. But if I project myself over the next 5 to 10 years, and I know you said the next 6 to 12 months, but I think actually the more important development that's unfolding right now is the quiet improvement in the in the China-India relationship. One of the anomalies in the world is that China and Russia are very good friends. Russia and India are very good friends, but it's not true that the friend of my friend is my friend, because China and India have not been friends. But this is starting to improve. They're talking about redoing direct flights. China said that they would pull back their troops from the contested border. And deep down, those two economies are actually super complementary. China has, cheap capital goods, cheap cost of funding. India has all the cheap labor that China no longer has. It also has, frankly, the potential for a better relationship with the West. And, like the Trump administration keeps trumpeting, we're about to do a deal with India. We're about to do a deal with India. Right. So it makes sense for Chinese factories to move to India. I think for me, this is, a super important trend for the next 10 years, because if you think about it, if you match Russia's cheap commodities with China's cheap machines and cheap cost of capital to India's cheap workforce, you have the potential for an economic boom of epic proportions. You have a potential for a lot of growth. Against this, China, Russia, China, US is interesting, but is that what's going to drive the world for the next 10 years? I'm not convinced. The way I look at the world, I think the US is essentially folding back onto Fortress America. It's essentially telling the rest of the world, you guys get out of the American continent. So Europe, you get out of Greenland. China, you get out of Panama. You get out of Argentina. You get out of Venezuela. We're getting out of Asia. We're getting out of Europe. We're folding back onto Fortress America, and that's that. That's a world in which the U.S. dollar goes down structurally, and it's a world in which, it opens up a big void for China to step in, for potentially for maybe the EU to step in, and it's so I'm actually, I know it's what's driving the markets right now, but I'm actually not that fussed about the China, Russia, the China, US. I think deep down, they'll get to a deal at some point because the US can't live with empty shelves at Walmart. It's just that simple. So at some point there'll be a deal, and that'll be that. But the deep structural trend is for more economic integration within the Asian continent, and for the U.S. to fall back onto the American continent. And within those deep structural trends, there'll be hits and starts, and back and forth. But deep down, that's where we're going. And that folding back of America onto the American continent for me is very bullish on Latin America, because that means that Latin America gets better deals from the U.S. because it's now more important to the U.S. Right. So it's good news for Latin America. And meanwhile, the broader integration of China within the whole Asian and frankly Eurasian continent is, I think, probably good news for the countries there.
Everyone, it was a pleasure speaking with Louis today, as he is someone who has lived on the ground in Hong Kong for over 30 years and has a deep knowledge of China. I'm going to drop links to his profile on X/Twitter down below, in addition to his investment research firm. Every day, I receive emails from people around the world asking me for advice on how to invest in China and where to find the best news and insights into the country. Louis and his team at Gavekal Research are one of the best resources that you can find. As always, I want to thank you for spending time with me today here on YouTube. And if you're interested to learn more about the U.S.-China trade war, click here to watch our next video. And I look forward to seeing you all in our next episode soon.